Welcome back to the channel. Today I need you to really sit with this question for a second. What if one morning you opened your crypto app and XRP wasn't a few bucks, it was sitting at $2,500 per coin? Sounds absolutely absurd, right? That's exactly the kind of headline that makes you roll your eyes and keep scrolling. But this week, a certain claim caught fire. A top crypto CEO didn't just hint. He outright predicted XRP could hit $2,500 and not sometime in the distant future either. At first glance, that sounds like fantasy land, but when you start digging into the logic behind it, things get a lot more interesting and maybe just maybe a little less insane than you'd expect. Now, look, I've been in XRP long enough to know how extreme some of the predictions out there get. You've got moon boys screaming for 10,000 XRP, while the cynics swear it'll never break $5 again. But this particular prediction didn't come from some random Twitter account or a Telegram hype group. It came from Jake Claver, the CEO of Digital Ascension Group. He's not promising moonshots. He's building an argument around economic mechanics, global liquidity, and institutional shockwaves. Still, the second I heard $2,500, I nearly spat out my coffee. That's about an 83,000% jump from today's price levels. So, yeah, this is a bold one. To put that in perspective, at $2,500, XRP's total market cap would be hovering around $150 trillion. For context, that's more than the entire global stock market combined, bigger than Apple, Microsoft, and Tesla together. On paper, it sounds ridiculous. People hear that and say, come on, that's more money than even exists. And yeah, I get it. You know, it sounds like science fiction. But here's the problem. Most people completely misunderstand what market cap actually represents. It's not real cash sitting somewhere. It's a notional figure, a snapshot based on the last trade price multiplied by total supply. It's not a bank vault full of $150 trillion waiting to be cashed in. That's where Claver's argument starts getting interesting. He doesn't even care about market cap. He calls it a distraction. He says that the real driver of XRP's price potential isn't theoretical value. It's liquidity, or more specifically, lack of it. The fewer coins available to trade and the more people who want them, the faster the price moves upward. In other words, he's calling for a perfect storm, a global supply shock where XRP becomes so scarce and so in demand that price discovery just goes vertical. Let's play with that logic for a second. Imagine if tomorrow every major XRP holder refused to sell. Exchanges would dry up, liquidity would evaporate, and the few coins floating around would be chased by buyers desperate to get their hands on some. The price would explode, not because of hype, but because the order books would get eaten alive. It's simple supply and demand. The smaller the available pool, the bigger the reaction. And that's where XRP's fixed supply comes, in 100 billion coins ever. No more can be created. There's no XRP Federal Reserve, no minting mechanism, no hidden button to inflate the supply. In fact, it's deflationary. And with each transaction, a small amount of XRP is permanently destroyed. That means, over time, there's actually less XRP in circulation, not more. So, we're talking about an asset that's both limited and shrinking. Combine that with rising demand, especially if institutions jump in, and you start to see why Claver says a supply shock could trigger an event we've never seen before. So, yeah, $2,500 sounds crazy. But what if the market dynamic itself, scarcity meeting utility, could make it possible under the right conditions? That's the rabbit hole we're going down today. Because if Claver's right, XRP isn't just another altcoin waiting for the next bull run. It's a ticking time bomb waiting for global finance to blink. And when it does, things could get violent in the charts real fast. Now, let's dig deeper into Jake Claver's actual reasoning. Because this isn't some random trust me bro prediction. His logic is grounded in a brutal economic truth. When demand outpaces supply, the price doesn't just rise, it explodes. Claver says, forget the endless market cap arguments. He doesn't care about trillion-dollar math or theoretical valuations. He's focused entirely on the available float, the XRP, that's actively for sale at any given time. That's what drives real price action. His analogy is simple. Imagine you walk into a marketplace where there are only a handful of apples left, but hundreds of buyers desperate to get one. The last apple won't go for $1, it'll go for whatever the highest bidder is willing to pay. That's the essence of his supply shock argument. XRP's total supply may be 100 billion, but most of that isn't actually available. A huge chunk is locked up in escrow held by Ripple or sitting idle in private wallets. The actual circulating amount ready to trade is shockingly low. Now combine that with the fact that XRP gets burned with every single transaction. It's mathematically programmed to get rarer over time. Right now, roughly 5,000 XRP are burned every single day. That might not sound like much, but zoom out. That's over 1.8 million XRP a year gone forever. It's a slow bleed, a deflationary drip that adds up over time. There's no printing, no inflation, no dilution, just a fixed and shrinking pie. The longer XRP is used, the smaller the supply becomes. Claver even jokes that XRP is the only deflationary asset on Earth besides uranium. Sounds like a throwaway line, but there's truth there. When you use uranium in a reactor, it gets consumed and you can't reuse it. XRP is the same. Once it's burned, it's gone forever. And that deflationary nature could become lethal for price discovery once the rest of the financial system starts relying on it for liquidity. Here's where things get wild. Claver doesn't think XRP goes vertical because of retail hype or tweets. He thinks it'll happen when global liquidity dries up and institutional systems need a neutral bridge asset that actually works under stress. That's when he believes XRP will suddenly move from niche crypto to global backbone. He calls it a perfect storm, not one event, but a chain reaction of global financial shifts that converge at once. Picture it. Traditional finance under pressure, liquidity evaporating, governments and banks scrambling for cross-border settlement tools that actually work in real time, and XRP with its instant settlement, 247 uptime, and deflationary supply becomes the one lifeboat still floating. Now think about what happens when institutions start competing to get that lifeboat. When major players like central banks, payment processors, and trading firms all need XRP for settlement, the open market can't keep up. Supply vanishes, price rockets. That's not hype. That's how markets work when scarcity collides with necessity. And Claver's point is it's not if, it's when. Because every signal he's watching suggests global finance is heading toward a structural liquidity crisis. Rising interest rates, carry trades unwinding, debt bubbles bursting. He's painting a picture where fiat systems start choking and only digital assets built for speed and settlement will survive. So, no, 2,500 XRP doesn't happen because of memes or FOMO. It happens when financial infrastructure itself starts breaking down and XRP's role as a bridge currency becomes indispensable. Claver's theory isn't built on dreams. It's built on friction, on the inefficiencies that have plagued global banking for decades. We're talking about a scenario where everything that's been holding XRP back, regulatory uncertainty, institutional hesitation, legacy inertia, suddenly flips into the exact fuel that drives its explosion. And if you're holding XRP when that supply shock hits, well, that's the kind of move that doesn't just make you money, it changes your entire perspective on what's possible in this market. Now, let's get into the real meat of Jake Claver's theory. The dominoes, he says, could trigger this supply shock because this isn't just about XRP being deflationary or having fixed supply. It's about what happens when global systems start breaking down and that scarcity suddenly matters. The first domino he points to is the unwinding of the reserve carry trade. Now, if you're not familiar, the carry trade is this old-school financial strategy where big players borrow cheap money from one market like Japan with its ultra-low interest rates and invest it somewhere else with higher yields. It's like borrowing at 1% and lending at 5%, pocketing the difference. Sounds easy, right? Until it collapses. Because when interest rates shift or global markets wobble, those borrowed funds have to rush back home. And when everyone unwinds at once, you get chaos. Liquidity vanishes, assets crash, and trillions of dollars evaporate overnight. Claver's point, when that tide reverses, capital has to go somewhere. and he believes a fraction of that fleeing liquidity could pour into XRP, not because it's a meme coin, but because it's one of the only bridges that can move value globally in seconds. Imagine that. The same institutions that once ignored XRP now desperately using it to stabilize their positions. Domino number 2, Tether in trouble. You don't need to be a conspiracy theorist to see that Tether's $100 billion shadow over the crypto markets is a ticking bomb. It's the oil that keeps everything running. But if regulators ever drop the hammer, or if confidence in its dollar reserves cracks, the shock would ripple across every exchange. Stablecoin panic, liquidity freeze, exchanges locking withdrawals, and we've seen smaller versions of it before. But in Claver's scenario, a Tether implosion doesn't destroy crypto entirely as it reshapes it, because when one pillar collapses, the market looks for stability. And if, by that point, XRP has clear regulatory status and institutional integration, it suddenly becomes the logical refuge. It's liquid, it's regulated, and it actually settles. 3 things Tether could never claim. Domino number 3 is wild. The Epstein files. At first glance, it sounds completely unrelated to crypto, but Claver argues it could be the spark for a broader trust crisis. He's implying that when those documents and links to financial corruption start surfacing us, and let's be real, they will. Some of the institutions tied up in those networks might also have exposure to parts of the crypto ecosystem, especially unregulated ones like Tether. That kind of scandal could crush trust, not just in individuals, but in entire systems. And in that environment of panic and revelation, investors and governments alike might pivot toward assets that are transparent, efficient, and compliant. That's where XRP shines. It's traceable, fast, and regulatory friendly. 3 magic words for institutions terrified of the next scandal. Then comes domino number 4, the Shane Ellis liquidity theory. This one's like XRP folklore. The idea is simple but terrifying for exchanges. If one massive buyer suddenly starts scooping up XRP, and there isn't enough on the books to fill those orders, prices would explode vertically. Each buy eats through the order book until there's almost nothing left to sell. Imagine a domino of instant scarcity. $10, $50, $100, then 500 XRP in minutes. Now combine that with the earlier dominoes. A carry trade collapse drying up fiat liquidity, Tether imploding, trust evaporating, and exchanges thin on supply. You've got the makings of an unprecedented liquidity storm. In that moment, Claver argues XRP becomes the most valuable lifeline in the financial ocean, the one asset still functioning when everything else is frozen. And the final domino, XRP's 247 advantage. When traditional markets close for the weekend, crypto doesn't. If a crisis hits Friday night, banks are shut. Swift's offline, the NYSE is dark, but XRP still settles in seconds. That's not just convenience. That's critical infrastructure, because when chaos hits, the institutions that can still move money are the ones that survive. So when Claver paints this picture, it's not some fantasy moonshot, it's a mechanical chain reaction. Each crisis drives liquidity toward the only system that still works. And when that flow hits XRP's tiny available supply, that's when $2,500 doesn't look impossible, it looks inevitable. Now let's connect all those dominoes to the real-world infrastructure quietly forming beneath our feet, because this is where Jake Claver's argument goes from theory to frighteningly plausible. You've probably heard about DTCC, the Depository, Trust, and Clearing Corporation, but most people don't realize it's basically the backbone of global finance. It clears and settles over $2.5 quadrillion in securities every single year. Stocks, bonds, derivatives, ETFs, nearly everything traded on Wall Street flows through DTCC's pipes. And here's where things get interesting. DTCC's new initiative, Project IN, is already live, not experimental, not theoretical, live. It's designed to transition the world's biggest financial transactions onto distributed ledger technology, DT, the same fundamental tech behind XRP. And while DTCC has been careful not to mention Ripple directly, the overlap is impossible to ignore. Their system runs on permissioned DT, aims to achieve near-instant settlement, and is built to integrate with tokenized assets, exactly what Ripple has been building for over a decade now. Imagine this. DTCC clearing trillions daily gradually begins tokenizing securities, treasury bonds, equities, maybe even commodities, and routing that through a DT bridge. When those assets start needing on-demand liquidity between currencies or across borders, what token do you think fits perfectly? One that's regulatory approved, institutionally connected, and already tested in banking corridors worldwide. XRP fits that description better than anything else. This is what Claver means when he says the XRP supply shock won't just be retail-driven, it'll be infrastructural. Because once entities like DTCC, FedNow, BIS, and ISO 2022 system start using digital ledgers that can talk to each other, every transaction becomes a potential XRP corridor. Every settlement could require a fraction of XRP for liquidity, and when those fractions are multiplied across quadrillions in daily settlement, that's how a cheap coin becomes a systemic asset. Let's be real, this is the part most retail investors can't wrap their heads around. They still think in terms of number go up, not in terms of utility compression. When trillions in institutional flow start competing for a finite supply of XRP, it's not hype, it's math. Supply shock isn't about buying pressure from traders, it's about forced demand from systems that can't function without that liquidity layer. Claver's angle is that Ripple's partnerships with banks, regulators, and payment networks aren't about short-term adoption. They're about positioning XRP inside the new rails before the old ones collapse. And when the old rails, Swift Tether fiat liquidity pools fail, the new rails don't just replace them, they reprick everything built on top. Now layer on the geopolitical tension, central banks hoarding gold, BRICS, nations pushing dollarization, U.S. debt at $35 trillion. These aren't isolated events, they're signals of a global reset already in motion. Nations are preparing for a world where instantaneous digital settlement across borders isn't a luxury and it's survival. And the few assets that can bridge those systems, CBDCs, stablecoins, and yes, XRP, become the new monetary arteries. So, when Claver says a 2,500 XRP isn't fantasy, he's not talking about a speculative pump, he's talking about a liquidity repricing event. The same way oil or gold skyrockets during global instability, XRP could become the bridge asset in a financial crisis where everything else seizes up. Think about that. A token that went from retail trading on Uphold to being embedded in the same infrastructure that moves global securities. DTCC doesn't test systems. For fun, they test for what's coming. And here's the twist. Ripple doesn't even have to announce it. Integration at this level doesn't start with flashy press releases. It happens quietly with APIs, institutional corridors, and compliance frameworks. By the time the public realizes what's happening, the price curve has already gone vertical, because when the DTCC and FedNow rails merge with blockchain liquidity, and when trillions in tokenized assets start settling near instantly, the race for XRP won't be retail, it'll be systemic panic buying. That's the scenario Claver says could unfold before the public even connects the dots. So, where does that leave us heading into 2025 and beyond? Let's strip away the noise and focus on what's actually forming beneath this market. Because Jake Claver's projection isn't built on retail hype or speculative dreams, it's built on an inevitable shift in how money moves globally. We're entering a world where tokenization isn't optional anymore. Every major financial body from the IMF and BIS to BlackRock CK, NASDAQ, and DTCC is openly saying the same thing: the future of value transfer will be digitized, tokenized, and settled in seconds. And once that shift hits critical mass, there's no going back. Traditional payment systems like SWIFT and AC aren't designed for real-time cross-asset liquidity. They'll either integrate with blockchain-based systems or fade out completely. Ripple, meanwhile, has already planted itself in the center of that new infrastructure, not as a speculative player, but as the connective tissue linking banks, CBDCs, and global liquidity hubs. Now here's where the numbers start making sense. Claver's 2,500 XRP target isn't just about price, it's about total network valuation. If XRP becomes the primary liquidity bridge for even a fraction of tokenized global assets, say 5% of the estimated 1.5 quadrillion global market, you're looking at trillions in flow requiring XRP for settlement. The math scales fast because the utility is exponential, not linear. Here's the key takeaway: XRP's next move won't be a retail-driven breakout. It'll be a structural repricing triggered by institutional liquidity migration. The DTCC's integration, BIS corridors, and ISO 2022 adoption are all paving the same road. Whether it's $500, $1,000, or $2,500, the direction is up. Not because of hype, but because of function, and function always wins in finance. That's why you're seeing Ripple quietly preparing regulatory compliance in multiple jurisdictions, onboarding private liquidity hubs, and expanding ODL corridors in Asia, the Middle East, and Latin America. This isn't about day traders anymore. It's about becoming the invisible engine behind global settlement. Once that happens, price discovery becomes a side effect of utility, not speculation. Let's be real, the majority of people won't see it coming. They'll laugh at $2,500 projections right up until XRP becomes integrated into systems like DTCC, FedNow, or BIS corridors. And at that point, it's no longer about belief, it's about infrastructure dependency. That's what Claver means by a supply shock. Once those rails go live and liquidity routing becomes automatic, retail won't have time to react. It'll already be priced in. So, yes, maybe the $2,500 number sounds wild today, but remember when people said Bitcoin would never hit $60,000, the same disbelief always precedes paradigm shifts. The only question left is timing. If you connect the dots, Ripple's institutional partnerships, DTCC's DT adoption, the BIS's interoperability goals, and the ISO 2022 rollout, we're staring at a multi-phase liquidity event that could unfold much faster than anyone expects. The groundwork is laid, the rails are tested, the players are aligned. All that's missing is the trigger. And when it comes, XRP's role won't be optional, it'll be essential. So if you've been waiting for confirmation, this is it. We're not in the speculative phase anymore, we're in the integration phase. And when the world wakes up to the reality of blockchain settlement at a global scale, XRP won't be trading in cents. It'll be the backbone of a new monetary era. We're witnessing the foundation of the next financial system, SH, and whether you're ready or not, it's already happening. This content is for educational and formational purposes only. It does not constitute financial, investment, or trading advice. Cryptocurrency markets are highly volatile, and every investment carries risk. Always conduct your own research and consult with a licensed financial advisor before making investment decisions.